Let's get across the market open now. David Lane joining us from Odd Minute. David, welcome to Tuesday. So interesting. Look, we are actually expecting a significantly lower open locally today, despite positivity, particularly more records on Wall Street.
Yes, that's right, Andrew. Reasonable night on Wall Street, although a little bit mixed again. But yeah, I think today we will see a bit of weakness. We've seen a few concerns that relate to Australia. China looks like they're having a few discussions around iron ore and potentially limiting some of the imports there. So we've seen the iron ore prices or the iron ore futures price come off. So probably likely to see a bit of an impact on the large miners here. But then also there's some reports that Donald Trump is now looking at increasing the minimum tariff level to between 15 or 20%, he said. So countries like Australia, who thought that we were out of the woods by having the minimum price of 10% and haven't really come to an agreement with the US, may well actually end up facing higher tariffs. So I think, yeah, we will see a little bit of weakness in the market today.
Yeah, I guess particularly the focus then will be on those major exporters to the US as to whether that's going to be felt, given the prospect, as you say, that essentially that tariff rate could double.
Absolutely, yeah. I think that we will see, an impact on those companies that do have direct trade with the US. Interestingly, there's just been some stats coming out that Australian wine exports to the US are at the lowest that they've been for 20 years. So the likes of Treasury Wines, for example, may well have a bit of a weaker day today. But other companies that are involved in trading with the US, again, we're facing that uncertainty, so we could well see some selling.
Meanwhile, David, raft of production updates. We are in the midst of that, particularly in the resources space. What have you seen so far this morning?
Yeah, you're right, Andrew. They're starting to come through. Sandfire Resources came through with their production update today. Their copper production was up fairly well, although they did indicate that they won't give a guidance as far as their copper cost production until their final result. So it looks like their production was reasonably good and in line with what the market was anticipating, although we did actually see the copper price come off quite a bit in overnight markets. So the copper futures were down about 2.7%. So that could have a bigger impact than the actual quarterly result from Sandfire. The other one that's just come through is St Barbara have reported record gold production. So, continuing on that theme of the gold producers doing well and, in a good environment. And St Barbara seems to be one of those that's capitalising on that with good production.
Mind you take a look particularly at the share price there, David. St Barbara's really certainly underperformed, hasn't it, relative to the others, given where the gold price has gone?
It absolutely has, yeah. So it could well be one of those stocks that, investors look around and look at some of the stocks that have done well, particularly in that gold sector, and shift into companies like St Barbara, particularly given that they are now improving their productivity and production. So could be an opportunity there.
Now, David, I also see you point to listed fund managers as doing well as a result of what we're seeing in the broader market at the moment.
Yeah, that's right. We've had a couple of recent updates from a number of the listed managers, Regal Partners, which manage a range of alternative investments. They've actually come through with some fund flow results, which were actually quite a bit ahead of our expectations. So quarterly fund flows of about up 7% over the quarter. They're now managing about $17.7 billion across a range of different strategies. And it's a really good manager that gives exposure to alternative assets, emerging companies, small companies, etc. So there's a range of different ways you can play that. You can actually buy the head stock, the RPL, which is the management company. We've got a buy recommendation on them. We've actually increased our target price from $3.60 to $4 because of that improved fund flow and we've increased our forecasts in the next 12 months by 48.4% for earnings per share, and by 16.3% in the next financial year. So, you can play that through the management company, or you can also look at some of the funds that are also listed investment companies as well. So RF1, which is their main fund, Regal Investment Fund, that has a spread across alternative assets as well as emerging companies, small companies. They've got some exposure to resource royalties as well as to water rights as well. So that's an interesting way to get exposure to alternative assets without being locked up, and you do have that liquidity of being listed on the market.
And elsewhere, GQG, what are you seeing there?
Yeah, GQG is a really interesting one. It's a global fund manager based in the US, and they do have funds all around the world, but it's actually listed on the ASX, and we see that as being a really good value investment. They've got a dividend yield of over 10%. We're forecasting that will increase, so we're forecasting about 11.5% next year and up to 12% the following year. Trading on a PE ratio of 8.7 times, so it's really attractive as far as the valuation is concerned. They have exposure to global markets. They have underperformed a little bit recently because they're a little bit concerned about the value of markets, so their portfolios are positioned a little bit defensively, but they've still continued to have very, very strong fund flows. So they've increased their fund flow by $0.7 billion US over the last quarter. So they now manage $172.4 billion of funds in US dollars. So it's a major fund manager, but as I said, listed here on the ASX. So it's an interesting way to get exposure to global markets and get a very, very good dividend yield.